Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a divorce valuation expert in St. Louis, Missouri. I have the pleasure of discussing fraud in times of divorce and following the money trail with Jason Pierce, a forensic accountant in Boston, Massachusetts. Let's kind of back up a little bit and start at the beginning. So you get some tax returns, you get some financial statements. What are you looking for to determine if there are indicators of fraud? Because just as we know that the business owner is kind of usually in control of all the finances of the business, and they may be telling their spouse like, oh, we're having a great year. Oh, we're so successful. It could be that there's a lot of debt involved, but also you have on the part of the non-moneyed spouse or the spouse that's outside of the business, you have a lot of mistrust. And so they always think that that spouse in the business is doing something to move the money and trick them, right? So what are some of the things that you look for to see if that could be true?
Yeah. How long is our podcast?
Right.
So it's interesting because we're just talking about like different states, and so let's say like Alaska doesn't have support purposes. So if you have this sort of seesaw or inverse relationship between if you're going to give somebody a higher income and then a lower value, you have it's just taken out of one pocket and put it in the other. Like, okay, cool. But if you're in a state where there's no support, then that difference on the value does make a huge consequence. So I just want to just like add that at the beginning there. But on the fraud side, there's ways to navigate this as a sole expert. There's ways to navigate this as a joint expert. In a joint expert, I just say, look, I'm not going to do forensic investigation. I'll do this valuation as is. If you guys want to hire somebody else and then come back later, cool. We'll just add that to the compensation. So whatever you can carve out off the financials once we're done, then that just becomes an income piece. So that is one way to deal with it. Let's say you are just a solo hired on one side. If you're the business owner side, well, you're probably not looking too much. And the reason I wrote that article in the Value Examiner was kind of dealing with that. Was I had this is a hypothetical situation, right? I had a situation where the business owner's expert said, oh yeah, there's nothing to see here, folks. It's just a book value sort of analysis, except that we like the income approach better, and the income approach was producing a value that's less than the asset value. And I'm like, that doesn't make any sense to me, but okay. Whereas I was on the outside, so here I am seeing you walk the parking lot and look at the fixed asset list of this 100-year-old business that's steady. It's in a boring industry, let's put it that way, right? That there's not a lot of like hockey stick kind of growth. It's just like slow and steady, and yet that doesn't make any money. So you see this lots of luxury vehicles, lots of evidence on the tax return. And granted, we didn't get a lot of information. There's just kind of like peeks into the general ledger. But you do see like non-deductible country club dues. I'm like, okay, so here you have a situation where the business doesn't make any money, and yet it's able to blow a lot of discretionary spending at these family members. And this was like a 4th generation business. So family members are just kind of scattered throughout this thing. So you have the situation where you could either like get it through the general ledger, should that be available. One of the reasons why I like divorce is you can get at the personal side. Whereas if it was just say, you're looking for forensic, like fraud in the financial statements from a shareholder dispute, you might not get everything if you're representing the minority shareholder, right? But in divorce, you could say, all right, give me your personal bank statements and credit card statements. Let's see the volume of spending that you live off of, and then we'll compare that to what the business is producing. And oftentimes that's it right there, because you can see this big disparity, and then we're done. Right. Otherwise, it is looking at, like, I don't want to say like individual like receipts, because like how do you deal with a Costco receipt and you're a contractor? They have a real nice house, but like it does look legit on the surface. So there is ways where what I address with that is to say, okay, these are category 1 type discretionary spending. this is a casino charge, right? This is your trip to the Von Trapp Lodge in Vermont, etc. So those we would definitely add back. Then there's a category 2, which would be, say, like the Home Depot charges or something that looks sort of business-like, but there's a lot of them, or maybe there is some overlay between the personal side or whatever, and then we just quantify those. And then what you could do is just say, here's the range. We know that we're going to add at least this much back, but we may add this much back. And then you kind of issue that range of value and work with it that way.